Good afternoon, everyone. So, as part of YGC Innovation Festival, we've been running several master classes, and today we are having a session on financial strategies for startups, navigating investor expectations and growth. So, we have two eminent resource persons to run this session for us today. We have Shan Nandakumar, who is the CEO of Momentum Venture Partners and President of ITW Foundation, and Madhushankar Yogindran, founder CEO of We Ignite, who will be conducting this session. Without taking much of your time, let me hand over the session to Nanda and Madhu.
Thank you, Avanna. Good afternoon, everybody.
Good afternoon.
One more time. Good afternoon, everyone. Okay, I'm sure with a lot of mentoring sessions, all of you must be tired, right? So some of you I can see sleepy already. So I'm sure this session is going to help you in your business to take your business idea to next level, right? So before I start, I thought it's going to be a smaller crowd, so we prepared this session to introduce each other, but I thought it is not going to be possible because we have 100 plus participants here. So what I'm going to ask you is, how many of you have already started a business? Can you raise your hand? Yes, running a business? Okay, fantastic. How many of you are thinking to start a business? I'm sure all of you. Is it? Yeah, fantastic. So, I'm Madhu. As Avanna said, I'm running a business, We Ignite, for the last 10 years. So, my entire career is with small businesses and startups. So, I've come across about 2,000 plus businesses to discuss examples. So, with that knowledge, I'm going to share a few things. But we have a very experienced person, Nanda here, so he's going to share a lot of things with us. I learned a lot from him, so he's mentoring me. So Nanda, over to you to introduce yourself first and then we can take it forward.
I'm not a very experienced person as such, but I have a lot of experience losing my hair.
You have to turn on it with the bucket. Now it's working. Check.
Can you hear me now? I think I'll be with you more technology here. Loud enough? Can you? Finally,
Yeah.
all sorts. Okay, make such a big difference, right? Thank you. Thank you for the introduction, Madhu. My name is Shan Nandakumar. I'm from US. I have worked in the Silicon Valley for a long time. Put it that way. I was a CFO for a wireless chip company, and I had a lot of experience trying to raise funds. As a startup, we had an idea around the table, and so we started with 3 or 4 people, and with the company we had to go pitch to all the venture capitalists in the famous road called Sandy Road in California, and we raised about $100 million. Took us 5 years to develop the chip in Taiwan and so on and so forth. So I do have a startup experience, but it's in a different environment. And now I am an investor in a pre-seed stage. So I actually have been investing in the accelerator program candidates who joined the YIT accelerator program. So far, in the last 4 years, around 30 companies. And the whole idea of my investment is to see more entrepreneurs right? It's a different perspective and venture capitalists, and especially companies which have an idea state or which don't have the capacity to scale. Venture investment is very difficult because the venture investment usually they have an 8-year life and they want a return in 8 years and they are expecting a return. So it's a different mindset or different agenda for those investors. So I have been mentoring Madhu. I believe in building the local capacity to sustain. So I just come and go from US when they need me. But my goal is to sort of build this community to be able to sustain itself. So that's where I am. So I have helped Madhu put together some information to be shared. It may be, it kind of has a Silicon Valley twist to it. So hopefully it is helpful to you. What you expect as you go progress further from where you are. And especially choosing the right investor at the right time, at the right amount, at the right ownership. Right? I mean, all of these steps are trade-offs. All of these steps are important. All of these steps determine your future. All of these steps determine your success and failure. So every step that you take in this regard is very important. And one of the underlying foundations for that is building a financial plan. Financial plan is like a roadmap, a navigation system. So without knowing how much cash you're going to burn or how much cash you're going to spend, how much cash you're going to need before you start earning, how much cash you need to raise. All these questions you need to be on top of it and not let the investor dictate to you and so on and so forth. So with that, I'm going to turn this over to Madhu and I'm just going to play a support role here.
So thank you very much, Nanda. So in this room we have some great experts here. My friend Raghu is here. He's from KPMG, very well expertise in this particular subject. So we can get a lot of learning from here. So experienced entrepreneurs like Saranya here, so we can learn from there. So this room we can learn a lot. And before I start, I have a few ground rules, right? So please put your phone on silent mode. Then we won't disturb you for this special session. And also, we have given this participant handout. For all of you got this? We printed only 100, we expected only 100. So yes, okay. So you can take down notes in each module, each presentation slides, and also a lot of activities we are planning today. So you can do those activities along with me. Then also, I'm not going to open it for question and answer. So I'll give about 15 minutes towards the end of the session for questions, right? So you can keep writing your questions, right? So then you can ask me at me and Nanda or anyone else here towards the end of the session. Is that okay, everyone? Yes? Yes? Okay, nice. Can you write down the first activity, right? What do you want to learn from this session? Can you write down your expectation quickly, 2-3 points? What do you want to learn from this session? What do you want to learn from this session? Can you write down a few points? Whatever comes to your mind, just write it down. Just write down what's your expectation from this particular session, what you want to learn. So why I'm asking this is like, once the session is over, just go through this particular expectation. If you feel like some points were not covered, then you can ask those as questions, right? So that's why I'm asking you, because we have, it's a broad area, we have put few things, right? Because we have only 90 minutes, right? So just write down what you want to learn. Okay. Done? Yes? Okay, great. So as Nanda said, financial strategy, before we understand why it is important, you should understand what is financial strategy, right? So if you take financial strategy is like a Google map, right? Just imagine that you are traveling from Vietnam to Colombo, right, in your car, right? So then you put Google map. What you can see there? When you put a Google map from Vietnam to Colombo, starting point and ending point, what are the things will come? The road map, yes. Then you can see how many kilometers, all these things, how many minutes, all this will come, isn't it? Yes? Yes? Okay. So, you're driving, right? Driving, so you have a car, you have fuel, right? So now you can calculate, say, if your car is like in 1 liter petrol, probably 10 kilometers you can run. Then you can calculate, okay, how many kilometers you can go with this existing petrol in the tank, right? Right, so where you have to stop, where to pump petrol, right? Then how you can peacefully reach the destination, right? Isn't that what you can plan in Google Map? Am I right? Yes? Okay. Similarly, just think financial strategy as that, right? So your business vehicle, you are driving in, right? Your fuel is your cash, right? If you don't plan, what will happen? You'll have to stop in the middle, right? You have to search for a petrol station, right? You don't know exactly where you are heading to, where the petrol station, so your entire journey will not be peaceful, right? So when you have a financial strategy, you will have a peaceful journey in your business, right? So why it is important? So most of the time startups fail, not because of their lack of ideas. Actually, everyone has brilliant ideas, right? Brilliant ideas, right? World best ideas. But in case if they can't manage the cash, they don't have cash, or if they can't manage the cash, most of the time those startups fail, right? So very important to plan your cash in the startup. And as I said, like you can plan your runway and also raise before the crisis, right? So before you get into that particular point, that crisis, right? You can identify, okay, how I'm going to get this fund for my business, right? That's very important. And balance the cash versus burn, right? Also ambition versus capacity. Yeah, like you don't overspend, right? You don't overspend on without understanding your capacity or without understanding your cash availability. And also sometimes what happens is like to deliver the customer promise, right? You try to deliver everything, not understanding our capacity as well, current capacity fundamental. So that is another challenge, right? And also this is going to help you to decide what kind of fund, when you are going to raise it, what, from whom you are going to raise it, right? So what's the right funding source, all these things you will understand. And also evaluating the option, right? Sometimes what happens, choosing the wrong option will cause a lot of damage to your business, right? So all this, you have to choose the right funding option as well. And also having a clear books and clear discipline, clear compliances, right? It will help you to attract the investors as well, right? And so it is going to be a proactive approach, right? Proactive approach. You are going to foresee the future, foresee the crisis, foresee the solutions, everything, so you can avoid the crisis. So every decision has financial impact. Every business I found it really important for you to understand that and take timely, effective decisions. And you need to understand the KPI. So we're going to discuss all these things in the next slide. And also you will identify some unprofitable activities in your business, having the proper finance plan, and forecast capital needs, ROIs, and also you will understand the burn and runway as well. So in this session, we have given, I'm going to talk few words that you should know as a key terms, but we have given towards the end of the page in your handbook here, those terms as well, right? So you can, you can read that after this session and get an understanding, right? So first one is equity, right? What is equity? What is equity? Anyone here? You can read here, right? You can read it. But what is equity? Your ownership, right? In your company, right? In your company, your ownership is your equity, right? As founder, now you're starting a business. If you are a one person, then you will have the full ownership of the business. Am I right? Yes? Then if you have a partner, you've got another partner, then you are thinking to have a split ownership. So then the partner also will have, like you can decide whether it's going to be 50-50 or 60-40 or whatever percentage, right? So you will have ownership, right? And ownership now is divided. Then like you are raising your funds, right? So then if you are giving it like, giving away like the next fund, right? Dilution starts, right? Dilution starts, right? So when you invest accounting, then you have to issue the shares, then your share portions are going to be, percentage is going to be reduced. So we are going to understand that towards the end of the session. Then valuation part of it, right? Valuation part of it. Valuation expert is here in this room, but definitely you will understand once you get your business as a value, right? When you get the capital in from the investors, your valuation is going to be different as well, right? So you will understand these terms, funding rounds, different funding rounds. So first, like different funding rounds, you have to understand this, and also product market fit, whether your product is accepted by the customer, or like whether you have you matched their demand, right? So these are the terms that you should know, but there are few other terms that we have given in the handout as well. Okay, let's understand different startup capital funding stages, right? Different startup capital funding stages. So first stage, pre-seed fund stage, right? So when I have some chat with a lot of entrepreneurs here, like all of you, most of you are in this particular stage. Am I right? Yes. How many of you think that you are in this particular stage? Yes. Raise your hand. Yeah. Okay. Please stage level, right? What exactly happening in this stage is like, okay, founding team established. Okay, you have an idea now. You are going to work on it. Okay, you have some other friends of yours, co-founders. They also start working on it. Okay, you have identified the core people, right? Now all of you put together and you are going to, you are going to take this journey forward. So in this stage, what is your key milestones are like, your team is set, whole team is set, and then complete the MVP part of it, and early market testing and feedback. Some of you have done that brilliantly. They have, when I speak to them and they said like, okay, I have done this part, I have done surveys, I have understood the pricing, I understood my customer's needs. So that's brilliant, right? So all of this should achieve in this particular stage. These are the things you have to achieve that is going to help to move to the second stage, that is seed stage, right? Early revenue. Now you have a prototype. Now you are going to put it to the actual customer. Now, so far, pricing and everything is assumption, right? You think, okay, this is going to be the price. Your customers are going to be accepting you. Or these are the features your customers are going to accepting you and buy, right? Now, when you go to the customer, then you will understand whether they are buying or not, right? So here in this stage, you are going to tested. You are going to start making revenue, right? So product is live now in market, early paying customers, so customers started paying now, and also early team expansion. Now you understood, okay, I have the 4 teams, we build the product, now probably you will start getting someone else to market it and get the clients on board. So all this will start happening in this particular session stage or seed stage, right? Then you move to the next. Okay, you have succeeded in that particular stage, right? So you need more capital, more expansion, so more growth. Then you will go to the Series A growth capital part of it, right? Yeah. So Nanjan,
yeah, I just wanted to bring up a few things from an investor perspective. Right. If you are at a pre-stage stage, those are the key deliverables that the investor is investing on, you deliver on. And after you already delivered, is the deliverable stage. So what are they looking at? I mean, if I'm investing at that point in time, I'm investing on people. Right? Essentially, the idea is still not validated. So I want to see whether you have a strong team, whether you are committed to the idea, right? And whether you have a clear idea of the problem you're solving, and you have a clear idea of what you are capable of to solve the problem. I want to know whether you can deliver those milestones for the investment I made. But there's one thing that I've learned in the past 4 years. One of the challenges is financial discipline. You know, I invest in a team. I don't know how they spend the money. 3 years later, still don't know. So, you know, with the funding comes some responsibility. Right? You are to be held accountable. You need to be responsible for the funding that investors betting on. And so that's why we keep emphasizing the financial discipline at a very early stage. We're going to start here. Okay, so I just want to make it clear that it's very important because most of these seems to be at this stage, right? And the next stage is funding. Again, not all investors are going to invest at the pre-stage or angel funding. Right? Now, typically, I'm just talking to some people who are venture engine in Colombo coming up in 2 weeks, and you know their expectations are completely different because they're looking at Series A or growth capital, so and also the company can scale because, as I said earlier, they are looking for a return. The next stage of funding, seed stage, we as an investor, we look for evidence of traction. That you have validated your idea, you have validated your business model, pricing and whatnot, and we have validated with customers, right? It's going to be market access, scale. Scaling is the biggest challenge. Ideas are plenty, but those ideas can be scaled to be a viable business, right? And by which time you would also have validated your financial models that you're projecting, because you now have a paying customer. You know how much is they're willing to pay for your solution. You know how much it's costing you to deliver those solutions, whether it is people or whether it is product. So you have, at a point in time, you have validated most of the assumptions that you started off with. And now you can project out, okay, I think I can go up to 2 million revenue per month or 3 million revenue per month or whatever the case might be. And my cost is going to be $1 million, so I have a 50% margin. So all of that get validated. At that point, then you have the investors willing to put more money in. Okay. And when you go to the growth capital stage, they are looking for whether you can scale top line, revenue growth, right? That's the key. And there are all kinds of ways you can fund it. So you also have various ways of funding the business at that point because you have a proven business model, including bank financing. There are pros and cons for every one of them we'll talk about. That keep the investor expectations at each stage. That's very important. And one of the things that is consistently important in all three stages is your financial plan. Okay?
Thanks, Nanda. Thank you very much. So, summary is here, so you can summarize it. So, investor expectation is the seed stage, strong founding need, early signs of demand, and here next step to reach readiness. Right? So, this is exactly Nanda was talking about. And seed stage, evidence of traction, scalable business model potential, and validated financial model assumptions. Again, but the growth stage is totally different expectation. Proper financial discipline. Now you have grown, you have great margin, you have property. So potential for exit within 3 to 7 years here, like investors will expect for a return in 3 to 7 years and 2 to 3 years track record and generating revenue. Right? So then you can move to the next step. Right? So with that, now we understood the various level of stages of startup, and then let's understand the funding options as well, right? So these are non-dilutive funding options, right? That means what we understood the equity, right? So you can keep 100% equity in this particular funding option, right? So equity is yours. So the first is bootstrapping, my favorite, because I started 10 years back like this, right? So get the cash what I have in the savings and started putting that, and buy a computer, started by myself as one person. So most of you, I'm sure most of you are like that, right? You have an idea, you start, you have to start it, so you put all your money what you have and start something somewhere, start building. This is a fantastic way of, in the initial stage, way of growing, right? So rather than at the initial point itself, diluting your equity, right, is the best way, because all these funding options have pros and cons, right? We'll discuss that. But when you have this bootstrapping, so you will understand how to manage the cash, but you have, this will be very little money you will have, so you will start putting that and start building up, like getting the clients, getting the revenue, and then put that back, building a staff. Slowly you will start building through revenue, through business revenue generation, right? So that's the first option. Second, then now you need more funds, right? Then you will go and ask your family, your friends, right? So and then whoever right? So they will give you. Actually, they will not expect you a return, right? They will not expect you equity, or they are not going to ask you interest rate. They will just support they will give you as a gift, right? You will start building through that particular fund, right? You will buy probably, you hire 2 more people, buy a laptop, you will start building your app, and then what will happen? So you start the next step, growth. So there are a lot of debt funding options available, right? So it can be say, why you choose this kind of funding option? Say example, your need can be a short-term working capital part, right? So short-term need, right? So for that you will not dilute your equity, right? So you can manage through debt funding, right? So you can generate, you have pipeline clients, you can get that money, you can sort out. You have a consistent revenue, already you have built it, right? So you don't need equity capital, right? So you can build that. So there are so many debt funding available, right? So I got my first loan in 2019, right? So when we start global expansion, so I went to Export Development Board, right? So I went and it's my idea, so I'm going to get clients, overseas, this is my requirement, this is my requirement, so I don't need to raise equity funding, I need debt funding, can you help me? So they gave me a recommendation letter to VOC. I went and checked with the manager, I talked to her and then fixed my idea. So they gave me 7 years, 1.5 million, 7 years loan, 4%, 1 year grace period. Isn't it great? Yes, there are funds available like that, so you have to go for it and see the options, right? See the options available. Yes, there are funds, right? And also concession loans available in the market, right? So recently I think they have put 8% loan as well for entrepreneurs, and there are other options as well. So you have to see the interest rate. Most importantly, you have to see whether your business is started generating consistent revenue. Otherwise, you will not. You can't pay the repayment of the loan. That is one of the challenge, right? But if you think that okay, you can manage that, also you can negotiate with them to give a grace period for a certain period of time, right? For sure, right? So there are schemes that you have to really go for it. And then customer advantage. This is one of the beautiful thing. Like even now we are managing like that. Like when we had to overseas market, so they love to put a bulk amount and then like we manage. So many times it helped us getting a customer advance, right? So you can ask for it. Like when you go for a project, get an advance from them in advance, then you build it through that, right? So that is also possible. So you don't need to dilute. And then grants and like competitions, lot of competitions happening. You can participate and win, and then they will give you some, startup funds. You can utilize them, and there are grants and schemes as I said, like concession loans and all. And then revenue-based financing, some innovative financing. I learned through Nanda. We're going to speak about that. Yeah.
Well, I mean, there are investors who depends on, again, depends on the type of business, depends if your revenue can be much more predictable, especially if you have a recurring revenue stream kind of business. Again, it may come at a later stage, not pre-seed. But at that point, there are investors who are willing to give you money and take royalties or a percentage of your revenue. So again, you're not giving up ownership, but you are giving them a percentage of the revenue that you grow. Of course, everything has pros and cons, trade-offs. One of the challenges of again, revenue financing is not applicable to every kind of business. Again, you've got to be careful about how you grow the revenue. Number one. Number two, you also have to be careful what percentage you give. If your profit margin is, let's just say 15%, and you give 20% of the revenue to the investor, you're left with not enough money, right? So you have to, but there are investors who are willing to provide that kind of financing, and then once you pay off the loan, the royalty stops, right? So again, it depends on the business and whatever revenue you are able to generate, and give confidence to the investor that you can scale.
Thanks, Nanda. Thank you very much. So, as Nanda said, like equity is crucial at the early stage, right? When you give up an equity, then you should know why, right? So, founders sometimes see their businesses high capital intensive, like you can't recover immediately, like you need some time, they go for it. Or like if the high risk model, they go for it, right? So likewise, there are circumstances that yes, you have to give up equity and get that fund to build it, right? So when I speak, few people they say like some innovative ideas, right? So you can't make revenue from day one, right? So definitely, so you need some more time to build it, and then only you can put it. So that kind of nature of businesses, yes, you have to go with equity, because when you go for debt funding, you won't be able to pay the interest. Right? So on a monthly basis. So here, like when you see equity funding, the first one, like there are individual investors or like institutional, so they take up equity and they support you for your growth, right? So then there are convertible notes. It's kind of left. Then like you will promise, okay, you will there's an interest component, and then together like they will have an investor will have an option to convert as a equity as well, right? So that is another option, and then simple agreement for future equity. It's a promise. Again, it's a promise, but it's different from the convertible note. So convertible note is kind of a debt initially, so interest component involved. Here, like no interest component, but it's a promise. Okay, I'm investing now, so you're saying like, okay, probably in 2 years time I'll give you this kind of equity. So that is your simple agreement. So it's like a agreement. And then incubators and accelerators. So like when you have a initial seed stage level, and also you just come and pick an idea. With that, they will support you with equity.
Reality accelerator is a clear example of that, right? The accelerator program that reality conducts. It's a 6 months program with the mentoring, and those who can meet some of the criteria, you get a certain amount of money as well. And at the end of the 6 months, your delivery will be going from pre-seed to seed stage. And those will be the deliverables over the 6 months. So I'm sure there are other accelerator programs around the country as well.
Fantastic, thank you. So with that, these are your okay. So we'll cover that part as well. And okay, so what are the mistakes normally founders, startups make when they raise funding? Choosing wrong investor and investment type as well. So if you choose the wrong investor type, then you'll end up with like kind of a lot of issues, right? So also you will have a opportunity cost as well. Underestimating non-financial obligations. There can be a lot of non-financial obligations. You need to really see what are the in your term sheet. You need to really understand what are the compliances are. And
just a second, I want to make sure everybody understand what a non-financial obligations are. Typically, again, this may have a Silicon Valley twist here. I'm not sure they comment. Some investors will ask to be a member of their board of directors. Some investors may put, if you spend anything more than, let's say, $1 million, they need their approval, right? Some investors would say, anybody you hire, they had to interview. So those are the non-financial obligations. So when you're negotiating with the investor, you make sure you have enough control, that you don't lose control of running the company, operating a company the way you want, and hiring and firing the right people. So then those are the non-financial obligations. I'm not sure how common it is in Sri Lanka, but it's very common in Silicon Valley. They put all kinds of restrictions on, anybody at the C-level hiring have to be approved by the board, and so on and so forth.
Okay. So next is not matching fund type of business stages. So this is what I said earlier, like when you are in the different stages, you need to understand what are the options available, which is suitable for your business, which stage you are in, what you have to do. So all these things you need really aware, right? So legal and compliances, again, that's covered earlier. And so that you need to understand where you are heading towards when you, and then whether it is those funding aligning with your strategic direction, right? Even a new investor is aligning with your strategic direction or any conflict of interest. All these things you need to really understand. And then
you can also explain the founder team economics. Typically, I mean, they may put a salary cap, right? As a founder, they may limit your salary. They may have a non-compete. That is, if you happen to leave the company, you cannot compete with the same idea for 1 year. I don't know what it is, how common it is. Again, this is pretty typical. Any patent that you file, they'll ask you to write to the company. So, again, these are things. Early stage, you often find it, but as you grow, early stage. So one more thing that I do need to emphasize is you've got to understand how many rounds that you may need to grow your business. Because every time you take money, you dilute your ownership. And the worst part is, let's say you take initial pre-stage stage in a certain valuation. If you say 5% ownership, they give you 10 million, there is an implied valuation. That 10% is, 10 million is worth 5%, right? But 2 years later, you say you want to go to the C stage or raise another round. And in the 2 years, you are expecting to make 10 million in revenue. But you are still only making 5 million in revenue. You couldn't get up that stage. Or you're not meeting the obligations of your first round. Then what happens? Your valuation doesn't change or actually go down. It could be. If your valuation doesn't change and you're giving more ownership to the next round of investors, the investor who invested the first round, they will also be diluted, their ownership. And some of them may not be ready for it. And I have seen it happening here. The previous round investor, no, I cannot be diluted. I want to have the same ownership. And the new investor said, well, your money is already spent. The company is only going to grow based on my money. So any kind of ownership you're taking is based on the money I give you now. So you can't have the same ownership. Those discussions will start happening and then will put a break on your part. So you have to be very careful about thinking about your financial plan on how many rounds it is going to take to scale to where you want to be. Now, if you're growing, if the revenue line grows faster than what you expected, of course, when your valuation goes up, then everything is fine. So, just keep that in mind in terms of raising investor capital.
Okay. So, with that, the next part, okay, so hope all of you have taken notes, right? So, we have discussed so many things, right? I'm sure all of you are taking notes, right? So, you can ask questions based on that. So, the next part is a financial model, right? So, you understand what exactly the funding options and everything. So, financial modeling, we will talk about 3 components. Start with your understanding of cost structure, right? Cost structure, what are the things that you need to understand in your cost structure? With the revenue model and cash flow statements, right? How you are going to create your revenue model, and then what are the other KPIs, key performance indicators for your businesses, right? Okay, so let's understand what is your cost structure, right? You will have 2 different cost initially startup costs and your operations costs, right? So can you tell me what are the startup costs you have, right? Rather than when you are having in operation, there are some other costs. What are the initial startup costs in your business, in your idea? Can you tell me something? Okay, you can answer in any language, right? It can be Tamil, Sinhala, and English. No issue. What are the costs? In your idea, like initially. Okay, company registration, yes, you register a company, right? Every month you are not going to register a company, right? It's not a recurring one, right? So it's the first time. So what are the other things? What are the other startup costs? So if you are getting probably shareholder agreement to be done, a lot of other things in the initial stage. One time you are going to do, right? So initial stage, right? Then what is operating cost? Like every month you will have some cost in your business, right? What are the costs? Rent, yes. What else? Salary, you have to pay salary, yes. You have to invest in marketing, yeah, right? So every month you will have some operating cost, right? So that you have to understand. And then fixed and variable. What is fixed cost in your business? There are costs. It is whether you are making revenue or not, you have to incur, right? We discussed that with you deep here. Certain costs, whether you make revenue or not, you have to incur. What are the costs? Yeah, so any rent, yes. What else? Salary, okay, fixed salary, yes, salary. Yes, what else? From the back benches, yes. What are the other costs? No? Okay, so variable cost every month. Right? You say to generate revenue, you must be having certain costs. So someone said, like when you make some products, you are giving piece labor cost. That is, every piece you are going to give labor cost. Yes, so that those are variable, right? So every probably every users you get, you will have different hosting costs, right? So different hosting costs. So those are variable. Likewise, there are fixed and variable costs in your business, right? One time and recurring cost, right? Burn rate and calculating burn rate, right? Okay, so what is burn rate, right? So say your cash in, right? Your cash inflow, right? So your revenue you are collecting money, your company, right? Is less than your cost, your spending money, right? So every month you will start burning your cash. Am I right? Yes? So you need to understand how much you are burning, right? So with your available fund, how many months you can survive, right? So every month when you burn, how many months you can survive with your available yeah.
So let me say why do you need to do this, right? You need to understand what is the cost of delivering your promises to the investor, right? What is the operating cost? What is the fixed cost? Fixed cost means that you have limited control over that. Variable cost means you have some control. Let's say you need estimating you need to hire 3 people, right? Now, one person could be a fixed cost. You have to hire minimum one person. The other two, if you're running out of cash, you can postpone hiring by a few months, 2 months, whatever the case may be, to extend your what we call the runway, right? The amount of cash you have and the number of months you can go. So the reason you need to understand what is the cost of operating and getting to where you want to be will determine how much money you're going to need to raise That's the main thing. You don't want to take too much money. You don't want to take too little money. Right? To know how much money you raise. Now, please take Steve. You come and tell me, now that you might not get million rupees. Now, my question is, okay, what for? How will you spend it? How long will it last? What will you be the deliverables when you spend this money? Right? So, to understand how much money you need is very important thing for a decision because you're giving up ownership at that point in time. Raising a lot of money is also bad. Raising not enough money is also bad. Right? That's why you have to spend the time to estimate your operating costs. And that's why Malu is emphasizing this. And he talked about burn rate. The burn is essentially how much you're spending every month. You need to know how much cash you're burning. That's what you call a burn rate. Now there's a concept, I don't know whether one is going to it. We call it burn to break even. What that means is how much cash you're going to burn before your revenue pays your bills. When the revenue pays your bills, that's break even. You're breaking even. Enough money you're generating to sustain your support. But you're going to burn some money until you get to that stage. So burn to break even is the amount that you need to raise. Okay. So that's why it's important to understand your cost structure.
So with that, actually, you can start building a cash flow statement, right? So you need to understand your cash flows, like how money comes in, how you are going to spend, right? So revenue assumptions, cash flow, you need to understand revenue assumptions as well, right? So a lot of people in this room, when I speak, they come up with a top to bottom approach. Like they're like, you said, okay, so in Sri Lanka, so many people are there. So out of that, I'm going to, get this much of people. I'm going to sell this percentage of people. You're going to sell. This way, like you are making assumptions, right? Yes, lot of people. Yes. So a lot of startups here, these startups. So, but just think about this as well. When you project your revenue, right? You need to really understand. We discussed about the capacity versus ambition, right? So when you can you sell the first 3 months this much of units? Can you sell? So if you are planning about 18,000 units, you say like, okay, someone said 18,000 units I'm going to sell in the first year, right? So with your capacity and the fund what you have available in your business, can you sell that 18,000, right? What is going to be your marketing effort? What is your team size and everything? Can you sell that? Then you have to decide what you can sell in the first 3 months or first 6 months, year one, what you can sell, right? What is the assumption, right? So it's all about you understand, okay, what you can sell, okay, what is your spending for the marketing, how you are going to spend that and get that revenue, get that customers, how many such customers you can get to make that revenue, right? So first you can go through bottom up as well, right? That up to right. So both can be used.
This will be important at the seed stage, right? At the seed stage, as an investor, you see what assumption you have validated, revenue assumption. Your top line growth is very important to me at that point in time. And the rate of growth. Now I have seen somebody coming to me and saying, okay, first year I'm making 1 million rupees. Second year I'm making 5 million rupees. Third year I'm making 10 million. Fourth year. So when you ask the question, okay, how do you jump from 1 to 5? Or 5 to 10? Or 10 to 20? You're doubling your revenue every year. What is your assumption? What is, So, as a seed investor, I'm looking at how you're scaling. The growth assumption is very important. So, the revenue line forecasting you need to be realistic. I mean, if you are over optimistic, you cannot deliver it. And then next round of the investment, your valuation will go down. Right. So,
அந்த panel video
focus
அந்த panel
on
video
your
support
value. I prefer bottom up. Simply because
அந்த உயரமாக panel உயர்த்தி இருக்குமല്ലോ அந்த வீடியோ கொடுத்த support உட எனக்கு
I can tell you how many customers I need in my first 6
செல்வா
months.
பிளஸ்ல இருந்தாலும் ஓகே அந்த டிஏ கடைசியாக
I
செஞ்சேன்
need the second 6 months. How much I can charge.
உயரமாக இருந்துச்சு
And so,
உயர்த்தி இருந்தேன்
I build a plan. I usually build a bottom up. And so that way I can answer all the questions an investor may ask. And the investor will be more comfortable because he knows your facts. He is confident that you can deliver on the revenue assumptions. Okay. So there's a top line projection. And sometimes it's we don't know for sure. Especially if you're trying to do some business exporting and whatnot. But at least you have reasonable assumptions.
So, and then next part is your sales and marketing. So, when we discuss some of the teams here, like they put, okay, how many users they're going to get, and they mentioned that assumption, right? So, when I asked, okay, how you're going to get that customer? A lot of people like struggle to answer that. I have noticed that. Right? How we are going to get that customer? Right? So, what are the channels? What are the marketing channels you use or sales channels you use to get that customer? Right? What is the cost involved in that as well? Right? So, how you are going to acquire that customer? Right? So, you need to understand that cost as well, but also what is the right channel to get your customer? They are in how we have to approach. What is the cost involved to get that customer? Right? So, identifying the right sales and marketing strategy is very important at the initial stage. And what is the associated cost also you need to know. And then cost of goods sold and gross margin, right? So whether it's a service industry or a manufacturing industry, GP is really important, right? Most of the time when I see in the service industry, they just neglect that part as well, GP part, right? But I prefer all service business also to know their GP margin as well, right? Software service or like customized software development, also like a lot of startups here, you should know what is your direct cost for sure, so and then get the GP margin for your business. So always see your margin. That is going to be the that is going to tell your true story, right? Not your revenue. Right? GP is your real story, right? So and then operating expenses and cash flow forecasting, right? So what are your operating expenses, right, in your business? You should be able to understand and forecast what are the operating expenses in different stages when you project, right? Understanding unit economics, right? Per customer, right? Per customer. So you said, someone said, 5,000 I'm going to charge every month, right? Every month I'm going to charge 5,000 rupees, right? What is the contribution for that, right? So contribution margin. So someone says, okay, probably my costing and everything put together 1,500, right? So what is your margin, contribution margin? 5,000 minus 1,500 is 3,500 is your contribution margin. Am I right? Yes. That you should be able to calculate one customer, what is the contribution margin? That is really important to understand, right? So when you calculate that, another thing that you have to understand, to get that one customer, what is your cost of acquisition? How you are going to get that customer, right? What is the cost involved, right? So someone said, look, I will run Facebook ad, right? So then when you run a Facebook ad, then you have to spend, say, when you put $10 in Facebook, how many leads you are going to generate, out of that, what is the conversion percentage, right? So what is the cost for that, converting that one customer, right? So you need to understand cost of customer acquisition cost as well, right? Then, like when you get that subscription going on, right? So what is your assumption? They are like, oh, like how many months they will bring that you can retain them, or what is the revenue they are going to bring you in, right? So that's your customer lifetime cycle, right? Value, right? The lifetime value. They are like, when you get a customer, right? So they are going to pay you subscription. Most of you are here like app development. That's why I'm taking that example, right? So they are going to say for 12 months or 24 months, right? Then how much of money that they are going to give you back? So early example, 3,500 rupees is your contribution margin. Say 24 months is around 84,000, right? Yeah, so 3,500 in 24 months you can retain. You get a customer, you pay probably 5,000 rupees as a customer acquisition. Yes, when you pay 5,000, you are going to generate 84,000, right? So is it good, right? For 5,000 you are spending, right? So your contribution margin is 3,500. That means in 1.5 months you can recover that money. Did you get that point? Right? Your contribution margin is 3,500. You are spending 5,000. So second 1.5 months you can get that money back, but you are investing in marketing, right? So that is your payback period in terms of marketing, right? So payback period. So you have 1.5 month payback period, right? Your customers are giving 84,000 rupees for 24 months. You are retaining 84,000. So investors will happy to see that, right? Happy to see that. Then they will give you money to invest more in marketing and get more clients, more such clients, right? Then you can generate more revenue, right? Does it make sense? Yes. So you need to understand those unit economics as well. Next, financial KPIs for most of the things I spoke here. So I'm just getting because of the time. Okay. So now let's do a small activity, right? So you can take your hand out.
Before going to the modeling activity, there should be a page with some numbers on it. This separate page. I hope you guys can read the numbers very soon. But just to give you an idea of if you are raising multiple rounds of capital, what happens to your ownership? Right, that's it. So round one it says, okay, pre-money valuation. So there's a concept of pre-money valuation and post-money valuation. What that means is you go to an investor, you ask for, let's just say 10% equity you're going to give, then you are raising 100 million. Right? That means your pre-money valuation is 100 million, you're giving away 10% of it. Right? They're going to put 10 million. So post-money valuation will be 110 million because now your company value is 100 and you're got cash $10 million from the investor, so now the company is worth 110 million. So that's the concept of pre-money valuation, the post-money valuation. Right. So in this scenario, in this example here, the pre-money valuation is 5 million. You have 10,000 shares, so the share price is 50 cents. Now you're raising 1 million. And still the share price is 50 cents. So for 1 million, you had issued 2 million shares. Right? So total number of shares that you end up issuing is 12 million. So if you look at that table below, it shows the ownership. So you own 10 million shares yourself, so it's 100% owned by the founders. Post, you still own 10 million shares, but you issue additional 2 million shares. Now your total is 12 million shares. So the 10 million shares that you own out of the 12 million, Now you own only 83% of the company. Right? It's the number of shares that you issue that determines the ownership. Okay. So 83%. So far you guys are reading, I hope this is not over complicating things. But when you really go into venture investing, it will become very important. Right? Round 2. So you have raised already 1 million. So when you go to round 2, now your pre-money valuation is 6 million. Share price is still 50 cents. That's assuming that your company has not made any progress, so your valuation remains the same. Now you will raise another 1 million to keep going. So now we have issued 2 more million shares. So now you have 14 million shares issued to the company. So if you look at the table below, pre-money, pre-new round, you own 83%, the investor in round 1 owns 70%. Now, post, you still own 10 million shares, but out of 14 million shares. So your ownership now is 71%. So you went all the way from 100% ownership down to 71% ownership. That's what we call dilution. Right? So you are diluting your ownership. So that's a concept you need to understand. And I can make it more complicated. Suppose you are not making progress and your valuation is dropped. Come down to 5 million. And then the 12 million shares, your share price is 42 cents effectively. Right? You raise 1 million at 42 cents. You have to issue 2.4 million shares. So if you look at the table below, you go from 83% ownership to 69% ownership. So that's why it's important to understand how many rounds of capital you need to raise before you could go further and the progress that you make. If you don't, too much money and early, too little money is also a challenge. But this is just something you have to understand when you go for venture capital and further sophistication than where you are today. I may have overcomplicated things for you, but it's something you need to understand. Alright.
Okay, so what we are going to do now, can you take down your this particular handbook, take that handbook. You can see the page, interactive activity or activity number 1, right? You can see some cases, right? Tech startup, service business, manufacturing startup, trading business, right? So most of you will be within this particular one of the industries, right? So if you are, say, example, tech startup, software products. So first exercise, right? So just estimate your runway, right? So just see your cash in bank is 5 million, your monthly burn is 1 million, right? So what is going to be your runway? Can you calculate that quickly? Let's do 5 minutes activity. So we have this very basic one, right? So you can do the activity 2 and 3 also. If you have time, then we can go further. But it's going to help you. So then we can spend 10 minutes for question and answer and we can wrap up, right? So shall we do that now? What is your runway? So we're going to summarize the entire session through this particular activity. Okay. You want one more? Okay, done. That is very basic activity, the first one, right? And then activity number 2. See your case, and then activity number 2, build your mini financial model, list 3 revenue assumptions. Okay, you understood what is your startup, right? Just list 3 revenue assumptions. How you are going to generate revenue. What is your assumption? And what are the separate fixed and variable costs in your business? Just write down separate fixed and variable costs. Third is like, it might take time, but just get an understanding. Just discuss with your team here, what is your inflows and outflows for next 6 months? Right? Can you write down what are your inflows, what are your revenue, and what are your costs for the next 6 months? How much you are going to make and how much you are going to burn, spend. So what is for the next 6 months? Can you do that quickly? I'm sure a lot of startups here, they have done the nice Excel worksheet. So you can refer those and you can write down those as well. So next activity, if you have done this, next one, activity number 3. Have you done that? You can do that at home, and then you can, if you have any doubt, you can ask. We'll be here for the next 2 days. You can ask that as well here.
As you go for preaching, there's one more thing that I think we should have mentioned here. Break even. If I'm on the family investor, I'm going to ask you how many months it's going to take you to break even. Your expenses are equal to your revenue, right? And then how much cash you're going to burn until break even. So burn to break even is the amount of money you have to raise. And when you will break even, you have to have it. When you pitch to me, I will ask the question, okay, when will you break even? Right? 6 months from now, 12 months from now, 1 year from now, 3 years from now. Okay, that's all you. I just want you to understand, the concept of breaking even. That's very important. If you say you break even in 6 years, I probably won't invest. So that's the concept you need to understand when you do your construction. Okay, I think another one I like, please just go around the table and answer any questions that you have.
So
if you have questions, okay.
Yeah, so activity number 3, you have to, what you have to do is just assume like now you have 100% ownership. So Nanda talk about the dilution as well, right? So if you are raising 2 million at 20%, what is going to be your equity, right? What is your equity? If you are raising 5 million for 25%, what is going to be your equity, right? That also just think about it and write it down, okay? So you can do it later, but yeah, so just get an understanding. Then KPIs, which 3 KPIs matter most in your industry, right? So we discussed a lot of KPIs. right? What are the top 3 KPIs for your business? And then your decision making part. Okay, so now you understood your projection, right? So action number 2, you understand your how much money you have to burn and what is your fund requirement. So just justify your funding choice, whether it is going to be an equity, loan or bootstrap. You are going to run through your money, right? So you have to choose one of the funding choice, right? So we discussed that, right? So then based on the case, you can identify if you are a SaaS, like your software services. I have mentioned the hiring part, right? You are going to hire, you are going to take a decision of I'm going to hire or not. So your question is like whether in this situation will you hire, right? Based on that case, right? And if your service expand, you are going to expand the team or delay. When are you going to expand based on that case, right? If you are a manufacturing, you have to decide you are going to invest in machinery or preserve cash, right? Based on that case, right? So likewise, you can practice this. Then it will give you an understanding about your business as well, right? So with that, if you have any questions, you can ask. And also the next page you can write down one key takeaway. One funding option I should explore is what? The KPI I need to track immediately is what? One mistake I must avoid is what? Just write down this is your key takeaway, right? And also what are the action plans for the next 30 days, right? With that, we will open it for question and answers. Any questions? Any questions from this table? Yes? Any questions?
Yeah,
You can ask me any language.
Yeah, let me ask, you wrote it down what you want to accomplish in this session, right, at the beginning. You meet those expectations. If not, what are the expectations that you have that we did not give on?
Yeah. Go ahead.
Sir, when I want to raise capital in the pre-seed investing, how should I evaluate the money that I need? Because just because I'm being a lead startup, I might be wants to humble and be very cost effective. So if I raise too low money for a 20% or 30% kind of a thing, then how I could be able to scale up after that? Like, so I want to have a clarity on that. How much would be a very good based on my.
I think how much depends on your financial plan, right? Okay, so that's why it's important to put the numbers down. Your estimates, what your cost is going to be to deliver on your solution. How long it's going to take to build a solution, minimum viable product. How long it's going to take to pilot with the customers or validate customer acquisition. So all that is the cost that you need to, right? Your burn. Understanding that burn until when you start revenue and how much revenue you can get, you have to have some idea, right? So the way you do this is if you take pre-seed money, take the pre-seed money for only for 6 months or 9 months, right? Don't take money for beyond that because you don't want to take too much money at that early stage because your idea may or may not be viable. So take that money only at this age. Within 1 year, I'm going to prove this all my revenue assumptions, my cost assumption, your customer acquisition cost, and your customer assumption, right? So that's how I would estimate how much money you need to raise. Raise enough to meet those deliverables that you plan on delivering within that time frame of 1 year. you have some tax to project out another 2 years to go for next round of funding. And again, don't raise too much money at the beginning because the ownership dilution happens pretty quickly. So there's no magic answer to whether it should be 2 million or 3 million or 5 million or whatever. It all depends on what the business cycle is. Right? Some business can scale very fast. They don't need money because it's based on projects. When the projects come, you go make a quotation and give them advance money and deliver on it. So you don't need to waste too much money, right? So it goes back to what I said earlier. Build your financial plan. When I took my statistics course, my statistics professor would say, DTDP, grow the damn picture. That's what he says. So I'm just going to tell you, grow the damn financial plan.
Good question, actually. Any other questions? Yes, you can ask in Tamil. Tamil,
Oh, English.
English. Tamil,
I think it's the end of the day, they are worn out. Right? Okay, yes. Not really big of a price. That's the question.
என்ன சொன்னால் என்னோட சின்ன கொஷின் இருக்கு எப்படின்னு சொன்னால் இப்போ ஆஸ் இன்வெஸ்டர் இப்போ நீங்கள் ஃபார் எக்ஸாம்பிள் நீங்கள் ஒரு இன்வெஸ்டர் இப்போ நான் இந்த ஃபினான்ஷியல் ப்ரொஜெக்ஷனில் வந்து என்னோட எம்ப்ளாயருக்கு வந்து என்னோட எம்ப்ளாயருக்கு நான் வந்து இப்போ போட்டு சாஃப்ட்வேர் இன்ஜினியர் 2,50,000. ஸோ வெளியே நீங்கள் கேட்பீங்களா ஏன் நீங்கள் இவருக்கு 2,50,000 கொடுத்துருக்கீங்கன்னு கேட்பீங்களா? ஏன்னு சொன்னால் எல்லா கேட்டகரியிலையும் வந்து எல்லா ப்ரொஜெக்ட்லையும் வந்து நம்மளாக வந்து எம்ப்ளாயிஸ் இருப்பாங்க. ஈவன் சேம் ஒர்க் பட் டிஃப்ரெண்ட் ப்ரைஸஸ். பட் கம்பெனி கல்ச்சரில் வந்து நான் ஒரு அட்ராக்ஷனுக்காண்டி அது நல்ல பீப்புள் ஹையர் பண்ணணுன்றதுக்காண்டி நாங்கள் வந்து ஒரு அட்ராக்டிவ் கவர்மெண்ட்டை போட்டால் அதை இன்வெஸ்டராக நீங்கள் எப்படி பார்ப்பீங்க?
As an investor, I'm looking to see, I mentioned about going to break even. Right? When are you going to break even? I don't care how much you pay for your employee. Because, as I said earlier, those are the non-financial constraints an investor could place. Right? And that's why it's important to choose the right type of investor. Some people like investing with oh, this is too much risk, they are so nervous about it. So you have to be careful with that. But if you ask me as an investor, I'm not an expert on the business idea or business solution idea. I don't claim to be, I can run your business. And I don't want to run your business. All I want to know is, okay, you have a good understanding of what it takes to commercialize your idea, build the top line growth, and be profitable. When I ask you, what's the burn to break even and when are you going to be profitable? Right? If you can answer me with a level of confidence, level of facts, so I need 3 employees, I have to hire. One of them has to be more experienced, and one of them, etc. Then I get a sense of that your stuff. I mean, as an investor, I meet you for half an hour at the most, 1 hour at the most. I will make my decision at that point in time. It's a gamble for me. So most of the time, unless somebody has been in your industry and he's been an entrepreneur himself and you are getting into the same field and he knows more than you, then that investor might ask a question.
Any other questions? Right, so as there are no more questions, I would like to take this opportunity to thank Nanda and Madhushankar for volunteering their time and doing this session for us. It definitely would have been very much useful for all these budding entrepreneurs. Most of them are at the early stage and some of them have already started and running the business. So it would be really helpful for them to understand the strategies and see how investors think and to work accordingly. Thank you so much. With that, we are actually closing the pitch competition day 1. But before we wind up, I want to give you all some instructions for tomorrow. So I want everyone's attention. Tomorrow we are starting the day at 8:30 a.m. So at 8:30 we are going to have your Startup Essential Award Ceremony, certificate awarding. So all of you went through Startup Essential course, isn't it? The bootcamp and with the submissions. So for all those who have done the submission successfully, we will award the certificates of completion of OP Startup Essential. So that will happen from 8:30 to 9:30 at the auditorium. So as you come, please go to the auditorium. If you want to come and leave your bags here, that's fine. Come, leave your bags here and then be seated in the auditorium by 8:30 in the morning. And then after 9:30, we are going to have pitch coaching mainly for you tomorrow. So we will be having pitch coaching and another round of business mentoring as well. So right after that, at 1:30, we are going to have qualifiers for the tech category. So we have more than 50 teams here in the tech category, and unfortunately, we are not able to accommodate all the 50 or 60 teams at the finale. Therefore, we will be doing the qualifier round tomorrow at 1:30 in this same place. So from 9:30 to 5, you will be in this same place tomorrow as well. Right? So whatever the feedback that you have got today, please work on that. Refine your pitch deck and come prepared for tomorrow so that with the feedback that you get tomorrow as well, you can pitch better at 1:30, from 1:30 onwards. So we will be giving you all the order only after 1:30 because we need to see the teams that arrives tomorrow in the morning as well. Right? Then whoever gets shortlisted, so we are going to shortlist 20 teams at the qualifier, and the 20 teams that get shortlisted from the qualifier will pitch at the finale on Sunday. But regardless of you being selected or not, we would like all of you to come and see the pitch of others as well, because there will be a lot of learnings for you to learn from that, especially from the Q&A, and you can understand what the investors' mindset, what they look at, and how you need to prepare yourself better, because this is not a competition where we just award the winners and finish it at that point. We take you through a longer journey. If you are serious about building your startup, we help beyond the competition, right? So if you are serious in building your business, I want you all to come all 3 on Sunday as well and see the pitch of others and learn from that and build your own startup. Right? So I hope the instructions are clear. So I would like to see all of you at 8:30 in the auditorium tomorrow morning. So we need to start and finish that on time, because if we get delayed, your mentoring time will get short. So we don't want to shorten the mentoring time. So therefore, please be on time. Between 8 and 8:30, arrive here and be seated at the auditorium at 8:30. Right? So auditorium is on the other block. Right? So you can ask anyone, they will guide you. Fine? Alright, thank you so much, and we will be around here for a couple of minutes. So if you all have